It's just buy it and hold it. But firstly, you have to deal with your own psychology. I'm down, I'm up, I FOMO, my friend made 100x, all of this shit, right? You need to stop all of that. And then you need to not use leverage. Because if the game is to hold onto your tokens from $2 trillion to $10 trillion to $200 trillion when it's a full mature asset class, the game is to keep hold of your tokens. Don't give anybody an attack vector to take your tokens off you.
Yep.
Which is why if you can self-custody, better. Certainly don't borrow against it because somebody will take your tokens. It's just like, don't do dumb shit when given the biggest opportunity of all time.
Over the past few weeks, since the cryptocurrency bull market went into full swing, Real Vision CEO Raoul has had a simple message for investors. Don't ruin this. Though he uses more colorful language, Pal's message about leverage and FOMO has been as clear as day. Doing either of these things to make greater returns on your tokens will cost you a great deal if and when you make the wrong moves. While Pal recognizes the advantage of using leverage to make more gains, he cautions that the cryptocurrency market is too volatile to make such moves, especially for beginners who are still acclimating to the whole setup. In one of his latest posts on X, Pal further emphasizes the importance of patience, proper planning, and not making careless decisions if you want to maximize the potential of the bull market. The post reads, "And still, half of TradFi fades the biggest macro trend of all time, in the best performing asset class of all time, in the shortest period of time. And still, they don't realize that the drawdowns are what creates the ludicrous opportunities, and that all it takes is to buy and hold on longer time horizons and compound the insane returns by adding during cyclical bear markets." Pal concludes the post with his signature phrase, "All we have to do is not this up." During his latest interview with Stefan, the Real Vision CEO and former Goldman Sachs executive reiterated these warnings and shared a personal story on the folly of using leverage in a volatile market. Pal explained that while leverage can and will cost you all your money, buying and holding onto your tokens will easily get you that 100x return when the asset class fully matures to a $200 trillion giant in the next few years. As we bring you clips from Pal's highly insightful interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
This is the biggest macro trade of all time. It's the best performing asset class in all history in the shortest period of time, right? So you've got the gift. I don't want to hear anybody say we've been shut out because everybody can put 10% in. Everybody, right? If you live in the Philippines or you live in Nigeria or you live in New York City, you can put 10% of your wages in, right? So this is an egalitarian, democratic, global, homogenous asset class. Yeah. And it is the biggest trending asset class of all time. Yeah. So given that, it's pretty easy. It's just buy it and hold it. But firstly, you have to deal with your own psychology. I'm down, I'm up, I FOMO, my friend made 100x, all of this shit, right? You need to stop all of that. And then you need to not use leverage. If the bloody asset class is going to go up another 100x from here, you honestly don't need to use leverage. You don't need to spend your whole time looking for the next 100x token and stick all your money and hopes and dreams in that. Just put 90% in the main asset classes and it'll do fine. You know, a bunch of it is degens, like, you know, I'm just going to get a 5x leverage, whatever, get washed out. They, you know, most of them are not putting their life savings. They're just trading. There's also a bunch of hedge funds, short-term people. There's market makers. There's all sorts of participants. But actually, crypto markets aren't that deep. Yeah. You know, what's also good is they're quite Austrian in how they work because, you know, the creative destruction cycle is all the time there, right? Because the margin gets called immediately. There's no negotiation. It just gets called and you're stopped out and it's done.
Right. Yeah. It's
the only thing we get with it where it wrong was when there's hidden leverage. And I've learned this in the past is when you go around and ask everybody who's your biggest client, if it's all the same person, then you've got a problem, particularly if they're using leverage. Long-term capital management was the classic example of that. I was on a stag weekend in Kilkenny, Ireland, and I was at NatWest at the time running the equity derivative desk. And a bunch of my friends were in equity derivatives and fixed income derivatives. And we were just having a few beers and the conversation comes up, who's your biggest client? Long-term capital. How much have you got? Oh, $1.5 billion in equity derivatives. I'm like, okay, what have you got? Oh, we've got, $1 billion. We had like $3 billion because clearly I was a better salesman. So obviously we had bigger positions. But then we went round. There's like, okay, we've got just between us lot on the boat, of which 4 or 5 people, we had maybe in equity derivatives alone, we probably had 5 times the value of the fund. I'm like, interesting. Then I spoke to a friend of mine who was the head of Bund trading at Deutsche Bank.
Yeah.
I'm like, how much you got? Goes, 50 billion. I'm like, holy shit. I went back to the risk manager on the Monday morning, hungover and tired, and said, listen, we've got to get out of this stuff. This is a disaster. But it happened again. It was actually 3 Arrows Capital.
Yeah.
None of us knew it. All of the CeFi projects had one client that was providing all the liquidity. And then when that client went, it all went. And we couldn't see that on chain. Is one of the problems of this market is there's very little secondary market professional liquidity. We have a bunch of trading shops.
Yep.
That's it. The rest is retail investors. The hedge fund industry in the entire crypto space is $5 billion. In traditional markets, it's 5 trillion. So we just don't have depth of market. So if you think what happened with Luna, once you start teasing apart who was trying to spoof whom, who was trying to bankrupt whom, between Binance, FTX, Luna, 3 Arrows, it's because there's not much capital in the space. So it's actually capital starved, which is great because it means the returns are very high, but not great because it means volatility is insane.
Over the past year, Real Vision CEO and co-founder Raoul Pal has had another important piece of advice for investors: how to get ahead of what he calls the 4th industrial revolution, or the exponential age. Pal explained that he realized the importance of the new age when he noticed a few things. First, central banks are printing more money than we ever thought possible. The reckless money printing from the Federal Reserve and its counterparts has inflated asset prices into what seems like a bubble. However, none of these technologies are actually in a bubble. It just seems so because the dollar has significantly lost value. Pal's conclusion from all this observation is that the price valuations of technologies will continue to grow exponentially over the next few years. In fact, the former Goldman Sachs executive believes we have only 6 years left before everything blows up exponentially and asset prices, especially cryptocurrencies and technology stocks, shoot through the roof. Here are more clips from the interview.
How I'm thinking this through is, we talked about this is the biggest macro trade of all time. We're still in the middle of it. So great, focus. Yes, you should be involved in technology. You should be investing, if even just to learn, right? Because the biggest change to mankind and society is underway. And crypto is just a part of it. That's just like the transaction, storage, value layer of the internet. That's just a part of the whole story. The bigger things are AI, robotics, genetic science, well, what that all unlocks, and energy. And this formula that I talk about is the GDP formula. GDP formula is basically population growth plus productivity growth plus debt growth, right? We stopped and blew up all debt growth in 2008. All debt growth now is just servicing of old debts. So really, the global economy, and particularly the developed world, has slowed down trend rate of GDP growth. Why? Because we've got an old, slow-growing population, and in many countries now shrinking. Italy, Japan, South Korea, Taiwan. I mean, they're all starting to shrink now. Okay, so you've got lower population growth supporting this large debt. So there's not enough money to pay for the debt, which is why the central banks print stuff. But over time, you need to change that equation. Because if not, we're not going to blow up because for us to blow up, which is what everybody fears, the value of collateral has to go down a lot, which is what happened in 2008. But we've learned this new trick: debase the currency and optically the collateral goes up, right? You cannot go bust in that environment. Nice. Well, not on a societal level. So, okay, how the hell do we get out of this quagmire? Slow growth, aging population. And the answer is, well, firstly, population growth. but nobody wants to open immigration because wages haven't gone up in real terms. So the more immigrants, the less money there is to share in the economic pie. So people are like, no, we don't want that. So then comes AI. AI is infinite human knowledge. And it's going to get cheaper and cheaper and cheaper until it's water. So you scale knowledge at zero cost, which is the human brain, and above that, because that's where we're going. And then you've got the robots, which scales physical humans. So now we have infinite humans at an exponentially decreasing cost. Next, productivity. Productivity is basically the output per kilojoule of energy.
Yeah.
If I look at UK electricity prices of the last 50 years, they're pretty stable. Like, sure, they're cyclical, but they're pretty stable.
Yeah.
So with EV technologies, geothermal, wind, all of the stuff that we're working on, we know that they don't scale enough yet, storage problems, other stuff, but we know they're going exponentially lower in price and they're rising in output. And then we've got nuclear and what we can do with nuclear technology. So we are going to halve and maybe halve again the cost of electricity in the next 10, 15 years. What is that going to do? Well, think of productivity. If technology goes down half, productivity's doubled. If it goes down half again, productivity's tripled. Yeah. So you're going to triple productivity while introducing infinite population. So what I'm suggesting is you have 6 years to make as much money as you can because you have no understanding what the world is going to look like.
Meanwhile, BlackRock, the world's largest management firm, is rapidly stepping up its Bitcoin game. According to a March 7th filing with the U.S. Securities and Exchange Commission (SEC), BlackRock is planning to buy spot Bitcoin ETFs for its Global Allocation Fund, a fund that invests in equities, debt, and money market securities, with around $17.8 billion in assets under management. According to the filing, Global Allocation Fund may purchase BlackRock's IBIT, as well as other spot Bitcoin ETFs, as long as they are listed and traded on national securities exchanges. A few days ago, BlackRock submitted a similar filing update for its Strategic Income Opportunities Fund, which will also be buying spot Bitcoin ETFs. Within the next weeks and months, more of BlackRock's multi-billion-dollar funds are expected to start buying Bitcoin for adequate portfolio diversification. What are your thoughts on PAL's video and BlackRock's ultra-bullish SEC filings? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.